And guys, you've had a little time to look through it. Marty, you told us last time around it was that net interest income that you were a little concerned about, the cutting exposure. Anything else that you think this might tell us about the other banks and what we should be watching for the rest of this earnings season?
Well, what we will make sure of is, we're seeing the pressure in NII, and we haven't really had the Fed cutting rates. So it's not really the short-term rates moving lower creating the pressure we're seeing now. This is really the tail end of rising interest rates and funding costs moving higher. So we're about to get some relief from that as the Fed begins to cut rates, and we're about to see the inverted yield curve right size and get more flat, which will also take a negative away. So all in all, what we're going to see is NII, not net interest margin, but NII continuing to grow with the capital story on the back end, which we kind of keep watching because share counts are going down 6, 7, and at some instances 10%, which is a really strong catalyst for these banks.
Mike, what do you think?
I mean, the backdrop for the bull case, let's say, on banks is that this particular quarter probably shouldn't be that big a swing factor because they're so cheap relative to the market. They're buying back so much stock. They yield 3%. It's really a bigger picture sector story that they are kind of underappreciated. I don't think these numbers do anything to argue against that. And in fact, if anything, the strong retail sales number is kind of your reason to think that the banks potentially have gotten too cheap, meaning did we over-anticipate a downturn in the economy? The consumer is still strong. Jamie Dimon talking about that right now. So that should be all good inputs. The question is, will the market hear it? Is the market going to continue to just penalize this group for being essentially no growth, just all about balance sheet financial engineering?
Marty, I mean, look, banks may not be what they once were, but there's some great news that we've seen and some great performance by some of these companies, including J.P. Morgan, which is trading down by 1.7%.
Well, and what the backdrop, when Mike just talked about the economic growth, the loan and deposit growth has been favorable. And then if you go down like Goldman Sachs, everything was favorable on the equity side, investing, lending. Fixed income was the only thing we saw some weakness in there. So tangible book values keep growing. Returns continue to stay flat to move higher. Your EPS is growing. So there's a fundamental strength behind the story. Credit costs remain low. And so really what we have to do is fight back what we're going to see a little bit of, which is margin compression this quarter. That's going to kind of invigorate that story a little bit more. And then we got to see the Fed cut in July and then see that numbers will still kind of hang in there and profitability won't be as negatively impacted as anticipated right now. And then that's where towards the back end of the year, the banks can outperform again.
Marty, which of these stocks would you buy right now?
So Goldman's the one we talked about in the kind of money center side. When we look at the super regional banks, what we want to see is those banks that are kind of restructuring. So we talked about going into earnings are banks that we've seen like Regions Bank or Zions, or you kind of roll into even like First Horizon, who reported well this morning. Also, we look for a high-quality bank like M&T Bank is a really good safety net for those that want to have some protection if things were to deteriorate. So, those are the ones that we want to look at that the market is over-anticipating impacts that aren't going to happen. And as they've changed their overall business mix, they've solidified and don't have as much pressure on the downside when short-term rates go down. They'll outperform, like we said, in the back half of the year.
Mike, we're bumping up against new highs every day and trading higher off of that once again this morning. Look, pretty good precursor for what to expect from this earnings.
The market's holding those highs right now. I mean, I think right now you could sort of make the case that, we're up 20% year to date. We've priced in a lot of the good stuff that we anticipate, including probably a July rate cut. But the bull case is that people don't really believe it that much, and people have been kind of taken by surprise at the strength they maybe feel. That's why, by the way, yesterday trading volume really low. Volatility has really drained away from this market. That can be, just kind of a market that kind of goes in the direction of least resistance, which right now is to drift higher. But earnings reports are always going to just kind of trap index level volatility.
In the brief pullbacks that the market has had in this year, do you know how many times people have calculated the market cap losses due to the tariffs?
That's been one exercise. Yeah, sure.
I heard 5 trillion, 8 trillion. So just being where we are right now with the tariffs doesn't, I think
there's zero chance that $5 trillion in market cap has been cost by the tariffs.
I'm talking about when it was down, people are quick to say that was a horrible move. We've lost $5 trillion. Trump, how do you say this to investors?
Right.
I mean, I've had the same person has said it like 5 or 6 times, and now we're at new highs. So is it because of the Fed or
But hold
what do you attribute it to? So obviously, I'm saying that obviously the tariffs.
The market is
the
always
tariffs are
about
still on
everything, and
Right,
the best
I know.
rallies.
You know what I'm saying.
And the best rallies in this bull market
On the way up,
have
we don't even talk
come
about it, yeah.
when a bad thing that we were anticipating didn't happen.
Well, the tariffs
And I
are still
think that's
on. It's
one of
just
the
that
things
there's a
that's going on.
truce.